There's a moment I think a lot of Forex traders recognize. The ISM manufacturing PMI comes out, the number beats expectations, the dollar spikes, and so the trade goes in because the logic seems airtight. Strong data equals strong currency. What could go wrong? A lot, as it turns out. And not because the trader lacked discipline or missed something on the chart. The problem runs much deeper than that. It's a structural misunderstanding of what ISM PMI data actually is, what it measures, and the role it's designed to play in a serious trading framework. I'm not here to criticize the instinct. The instinct makes sense on the surface. Strong economic data should support a currency, and that connection is very real. The failure isn't in the relationship, it's in how traders try to use it in real time. What I want to do in this video is explain what ISM PMI reports actually communicate, why treating them as entry triggers creates a structural problem, and how I think about this kind of data when I'm working on longer time frames. The goal is a clear understanding of the tool, not a replacement for it. The logic behind trading ISM PMI releases is straightforward, and I want to present it honestly because it isn't wrong in principle. The ISM Manufacturing PMI and the ISM Services PMI are monthly surveys. They measure the health of the manufacturing and services sectors in the United States. They draw on responses from purchasing managers who track metrics such as new orders, production levels, employment, and inventories. The result is a single composite number. Above 50 means expansion, below 50 means contraction, and the ISM publishes this monthly, and the release date is on the economic calendar in advance. The trader's logic goes something like this. If the PMI comes in above expectations, the economy is stronger than the market thought. A stronger economy supports tighter monetary policy. Tighter monetary policy means higher interest rates. Higher interest rates attracts capital. Capital flows support currency appreciation, so you buy the dollar. And that's not a flawed chain of reasoning. Every link in it reflects something real about how macroeconomic dynamics influence currency markets. And PMI data does affect GDP projections. The Federal Reserve monitors this data when assessing monetary policy. Strong readings do influence investor sentiment and currency flows. The appeal is also practical. The release time is known, the number is binary enough to generate an immediate reaction. It feels like an edge with a clear setup and a predictable trigger. And for traders looking for structured opportunities, it appears to offer exactly that. And this is precisely why it persists. The logic is coherent, the market does react. The problem isn't visible until you look more carefully at what's happening around each of those reactions. The structural problem with trading PMI releases as entry triggers comes down to one word: expectation. Markets don't react to the PMI number. They react to the difference between the number and what was already expected. And by the time a PMI report is released, institutional participants have already priced in their best estimate of what the number will show. That expectation is embedded in the currency before the data drops. So, a strong PMI reading doesn't automatically produce a strong dollar move. If the strong reading was anticipated, it's already priced in. The actual release confirms expectations, and the market moves very little, or sometimes reverses, as traders who positioned ahead of the release take profits. There's a second layer to this. Even when a PMI reading genuinely surprises the market, the initial reaction is often fast, volatile, and quickly reassessed. Within the same session or within a day or two, the market frequently reverses that spike as other data, considerations, and participants respond. The trader who entered on the release candle is now holding a position in the middle of that reassessment. And there's a third layer. The PMI is a survey of purchasing managers. It is a leading indicator, meaning it reflects expectations and conditions that may or may not materialize in actual economic output. A strong PMI reading is a positive signal. It's not a guarantee of the growth it implies. The market understands this distinction. Reaction to a single PMI print is therefore rarely a durable move. For position traders specifically, people holding for days or weeks, building a position around a single data release introduces a different kind of risk. The entry is reactive, the rationale is narrow, and the time frame of the data point rarely matches the time frame of the trade. My relationship with PMI data is fundamentally different from the release trade approach. And the difference isn't about having better reflexes or faster execution. It's about what question I'm asking the data to answer. When traders try to time entries, they're asking, what will the market do in the next hour? When I look at PMI data, I'm asking something very different. What does this data tell me about the structural trajectory of this economy over the next several months? That's a different question, and it produces a different kind of analysis. What ISM PMI data does extremely well is reveal trends and momentum in economic activity. A single reading above 50 is modestly useful, but a sequence of readings, say 6 consecutive months of declining manufacturing PMI, even if each individual print is still above 50, tells me something genuinely important. It tells me that expansion is slowing. The trajectory of industrial activity is shifting. The Federal Reserve may eventually be forced to reconsider its policy stance. That's the kind of information that informs a position trade, not a decision made on the day of the release, but a structural view built over weeks of watching the data evolve. I also use PMI data alongside other indicators, GDP trends, employment data, central bank communications, to build a coherent picture of where an economy is in its cycle. The PMI is one input into a larger framework, not a standalone signal. The ISM manufacturing PMI connects directly to export competitiveness, trade flows, and industrial investment. The ISM services PMI, increasingly important. In a services-dominant economy, it reflects employment, consumer confidence, and spending momentum. Together, they describe the two major engines of U.S. economic activity. I read them as a narrative, not as a binary trigger. If this approach has structural problems, why does it remain so widely practiced? The first reason is visibility. ISM PMI releases are on every major economic calendar. Brokers highlight them. Financial media covers them in real time. The price movement around the release is visible and immediate, and that visibility creates the impression of a tradable event. And for very short-term traders, it sometimes is one. The tactics persistence in that world bleeds into how data is framed across trading education more broadly. The second reason is that the logic is coherent enough to produce occasional success. Sometimes a PMI beat does produce a sustained directional move. The underlying logic is right often enough that the connection seems reliable. The failures, the spikes that reverse, the beats that produce no movement are easier to explain away than to learn from. The third reason is simplicity. Reducing a complex economic reading to above or below expectation and mapping it directly to a buy or sell is a format that travels easily. It can be communicated in a single sentence. It fits cleanly into trading tutorials and market commentary. None of this is a product of bad intent. It's a natural outcome of how a genuinely complex tool gets simplified for a wider audience and how those simplifications then become the default understanding. For traders working on daily and weekly charts, ISM PMI data is genuinely useful. The key is using it in a way that matches the time frame and the type of decision being made. At position trading timeframes, I treat PMI data as context, not a trigger. It tells me something about the economic environment in which my trade is operating. A currency pair in which one economy shows consecutive months of PMI deterioration and the other shows sustained expansion is a fundamentally different environment from one in which both economies move in the same direction. That environmental context informs how I read the chart. It gives weight to technical signals that align with the underlying economic structure. It helps me understand why a level is held or why a trend has persisted in ways that price alone doesn't reveal. I also find that PMI trends can serve as an early warning system. A deteriorating manufacturing PMI over multiple months often signals that a broader slowdown is developing, one that may eventually shift central bank policy and with it, the currency. Recognizing that early gives me time to orient quickly before the move is obvious on the chart. What PMI data does not do for me at position trading timeframes is generate entries. I don't buy a currency because a PMI report was strong. I use a PMI data pattern alongside with the technical structure and the broader fundamental picture to develop a well-supported view of where a currency pair is likely to move over the coming months. That's a slower process, and it's less exciting than trading a release. But it's the kind of process that produces decisions with genuine structural grounding, and that's what position trading requires. Understanding ISM PMI correctly doesn't mean using it less. It means using it differently. The data is valuable. The ISM manufacturing PMI and the ISM services PMI are among the most carefully watched economic indicators in global markets, and for good reason. They're timely, comprehensive, and they reflect something real about the health of the world's largest economy. But their value to me as a position trader is structural, not tactical. They inform the environment. They reveal the trajectory. They add a layer of fundamental confirmation or tension to the technical picture I'm building on the chart. The shift in approach is subtle but significant. Instead of watching the release and reacting to the number, I'm watching the trend across multiple releases and incorporating it into a view that evolves over time. That's a slower, more deliberate kind of analysis, and it fits the patience that position trading demands. If you want the complete framework for how ISM manufacturing PMI and services PMI fit into Forex market analysis, including how GDP projections, monetary policy expectations, and market sentiment all connect to these reports, the full article, ISM Manufacturing PMI and Services PMI, Trading Economics, is linked in the description. It covers everything we've discussed here in detail and provides the foundation for integrating this data correctly. Until next time, best to your trading.